When it comes to technical indicators, there should be little doubt that MACD indicator is clearly amongst one of the popular ones out there. While I've already created a few videos to demonstrate various applications of this indicator, today's video will focus primarily on the basics of the tool itself, as this is where most people go wrong. Just trying to understand the calculation by itself is hardly of any help, and most videos direct people to search for crossovers for trading decisions. While it may provide occasional success, knowing the inner workings of the tool will ensure better reliability. I decided to create a no-nonsense video, and I hope that this will provide a good source of education into this marvelous tool. Commonly called MACD, short for Moving Average Convergence Divergence, it can be a really effective tool to identify and track price momentum and potential breakouts. As a core principle, this indicator compares short-term and long-term moving averages and operates based on their interplay to determine the strength and direction of price change. So what is all the fuss about MACD not being easy to use? Well, see, the problem is most technical indicators and momentum oscillators operate with 1 to 2 key components. However, when it comes to MACD, it has 4 key elements. Now, understanding each of these components is important to use this tool effectively. This can be slightly intimidating for new users. I will therefore try to explain each of these components in a manner that will make it really simple to adopt this tool. Let's begin by quickly discussing each of the 4 components of MACD indicator. First of all, MACD indicator is not usually used as an overlay. Overlay are indicators that are added as a layer within the price chart. A good example of this will be Bollinger Bands. In general, when we will add MACD indicator to our technical screen, it will be added below the price chart by default and appear somewhat like this. The most important element of this indicator is the MACD line. This line tracks the variance between short-term and long-term exponential moving average. This is something we have heard a number of times. But what does this really mean? Short-term average is an indication of recent price trend, whereas long-term average represents the trend over a longer period. Therefore, when we make a difference between the two lines, we are actually not interested in some mathematical calculation. But what we are interested in is to find if the short-term price is moving ahead of the long-term price, which represents a bullish scenario, whereas if the short-term price is moving behind the long-term price, it is a bearish scenario. Now let's work with a real-life example using Apple stock, the case study. Let's search and add the MACD indicator to our chart. Remember our 4 key components: the MACD line, the signal line, the histogram, and the zero line. Let's begin with the MACD line. If you remember that the MACD line is calculated by subtracting the 26-period exponential moving average from 12-period exponential moving average. To explain this, I will add the 12-period and 26-period moving averages to my price chart. Just for the ease of telling them apart, I've used green color for 12-period and red color for 26-period average. By using exponential moving average instead of simple moving average, our chart will be more responsive to price changes and hence provide a better signal for change in price momentum. By looking at the 3 lines together, we can easily see that MACD line is nothing more than an indication of where the 12-period average is with reference to 26-period average. When the MACD line is in the positive zone, it means that at this moment, the short-term average is ahead of the long-term average. On the other hand, when it is in the negative zone, it indicates that the short-term price is lagging behind the long-term price. Hence, in a quick glance, we can get immediate signal for bullish or bearish sentiment. The next key element is what we call as the signal line. This line does not track price or moving average itself. It instead tracks the MACD line. In doing this, it indicates the rate of change of MACD line, and therefore it is of significant importance for us. The MACD indicator is somewhat unique in this sense that it just does not have the indicator line but also comes with an inbuilt signal mechanism which tells us if the momentum is making a turnaround. Signal line is the 9-period exponential moving average of the MACD line and therefore key to signaling the change in momentum that is identified by the MACD line. Using the MACD and signal line together can indicate the potential onset of bullish and bearish trends, and this is where the crossovers become important. These crossovers are of particular interest as they indicate that the MACD line has not only changed the direction, but the momentum is also making a turnaround. In a way, they are predicting the possibility of the crossover between MACD and zero lines, or as we learned, the crossover between short-term and long-term price averages. And in this way, MACD line is a step ahead of moving average crossover strategy. When one looks at the indicator chart, it is really easy to identify these crossovers, as these are the points where these two lines intersect each other. When the signal line crosses under the MACD line in the bearish zone, it shows that the price is set for reversal and a potential bullish movement. On the contrary, when the signal line crosses over the MACD line while in the bullish zone, this is an indication of potential bearish movement. Our next element is the zero line, which works as a point of reference and separates the bullish and bearish zones. Let's take a step back. Remember when we discussed that if we assume MACD line to represent the short-term moving average, then zero line represents the longer term moving average. Hence, the zone above the zero line is termed as bullish. That is, that the current price based on its short term moving average is in bullish phase when it is compared to its longer term moving average. Similarly, the zone below the zero line is termed as bearish zone. And following the mean reversion principle, the MACD line continues to move between these two zones. Let's do a quick recap of what we have learned so far. MACD line tracks short-term price against the long-term price. Signal line tracks MACD line to identify change in momentum. Crossovers are the points where signal line intersects the MACD line. Why did we even need a histogram? As if this chart was not already confusing enough. Our goal is to find the right crossover point, as it will indicate upcoming shift in momentum and a potential moving average crossover. This is where histogram comes into the picture. Histogram indicates the difference between the MACD line and signal line at any given point. But they are more than just this. They also visually indicate if this difference between the two lines is increasing or decreasing. This is indicated by the different shades in the histogram. By default, the darker colors will indicate increase in variance, whereas lighter colors will indicate that these lines are now converging. I hope you enjoyed this video. Please give a thumbs up and leave a comment if you like more such videos in future.